Hi, this is John Kumarianos with Capital Considered. We have had a bit of a hiatus, but we are back here in mid-July. It is July 14th as we're recording. We're going to have some interviews coming up, I hope, but this is a quick markets update. A little more than half the year is over. The year half ended, of course, on June 30th. So first chart up is, of course, the S&P 500. This is the TR, or the total return version, which means it includes dividends. We indexed this to 100 at the start of the year, so it's as if you can look at this as if you invested $100 in the index at the beginning of the year and see how it did. So we had a decline in February, and then of course we had Liberation Day in early April. So the market was already down, your $100 was already down to 95, and then it went down to 85 in rather short order. Of course, there was a pause on April 8th, and then the market kind of shot up a little bit, down a little bit, and then it's been up pretty steadily ever since. So we are up 7% on the S&P 500, including dividends for the year. Not a bad year if it sticks, but of course now there are new tariff threats. So we'll see what happens. I wanted to move on to foreign markets because this is a big story for the year. So this is a bar chart. The S&P 500 is at the bottom, and you can see it's up 7.18% through July 11th. All the other bars represent foreign stocks. Let's go through them, starting at the top. Emerging market stock index in local currency is up almost 12%, 11.94. But translated back to the dollar, it's up 16%. So the dollar has weakened. And when you're a U.S. investor, you get exposure to foreign stocks, you get exposure to foreign currencies as well, unless you use a currency hedge. Most people don't. And that's been a benefit. That is getting exposure to the foreign currency. So it's given you an extra 4 percentage points here on the emerging markets index, from 12 to about 16. Moving to the yellow bars, that's the EFA, as we call it, or the developed country index. So Europe, Japan, Australia, Western Europe, that is. And so this is up 8.43% in local terms, just a little bit ahead of the S&P 500. But if you've invested in this with your dollars and gotten euro exposure and yen exposure, you're up 19% for the year through July 11th. That's a big gain. So the dollar falling is a big story here. In addition to foreign stocks just doing a little bit better on their own, in their own currencies as well. Next chart, I wanted to show sectors of the S&P 500, and we can see industrials are the best sector, 14.78. So no longer tech as the leader, although tech is number 3 on this list. Infotech is up 9.8%, but not as good as utilities, which are a kind of tech adjacent play because AI is, of course, going to use so much electricity. And then the number 1 again is industrials at 14.78. Down on the list is consumer discretionary at -2, and healthcare also is having a bad year at -0.83, so just around -1% for the S&P 500 healthcare sector. Real estate a bit sluggish, up 3.85, not terrible, but not as good as the overall index. Again, up a little over 7% for the year. I happen to think real estate is cheaper than the broad market, so I don't mind people having some exposure to it. However, better to get that exposure in an IRA or a 401k or in a tax sheltered account, because the dividends that REITs kick off are not handled well by the IRS. So that's the news. Markets up for the year, although pretty volatile with tariffs. We'll see what happens for the rest of the year now that tariffs are coming back into play. And again, as I said, we hope to have some interviews coming up over the next couple of weeks. But for now, this is John Kumarianos signing off for Capital Considered. Thank you for watching.